So in the previous lecture, we still continue with topic 1. And in the last lecture, we stopped at the elements of financial information. So we know that there are 5 elements of financial information: assets, liability, equity, income, and expense. So it means whatever we are recording in our financial statement, whatever we are recording in our accounts, financial accounts, all the information comes under these 5 different type of elements, nothing out of that, right? So these are the elements of financial information, right? Okay, so now we start with the first elements. I already gave you ideas, the difference between, the meaning of assets, liability, equity, income, and expense. So assets represent the rights, any kinds of actions that lead to the inflow of economic benefits, that assets. Liability is obligations, which indicates any kinds of event which lead to outflow of economic benefits. Third is the equity, which means residual interest, or total assets minus total liability is equity, right? Then income, any kinds of money that we are generating by selling product and services, maybe operating and non-operating, mostly focus on the product and services. That's called the income. And expense, whatever money we spend to produce and sell the product and services. Maybe some other kinds of expenses that occur time to time in a business, that's called the cost. And you know that income minus expense or sales minus cost is profit or loss, right? So that was the elements that we discussed in the last lecture. So before we move on to the one by one, all the elements, do you have any question? Anybody has any question before we move on?
No, I don't have.
No questions. So let's move on to
teacher.
Yep.
Can you explain more about inflow and outflow of economic benefits?
Okay. Inflow and outflow of economic benefits means the return. For example, same thing that I mentioned in the last lecture, but I repeat again. We start a business, right? If you want to start a business, what we need finance, right? Finance comes from equity. Equity means selling stocks, selling shares, right? And debts. Debts means liability, which means bank loan, borrow from bank, right? Once we got capital, once we get finance, what are we going to do with this finance? We're going to invest. We're going to invest. Where are we going to invest? We invest in buying assets. All right. So your question is, what is the meaning of outflow of economic benefits? Outflow of economic benefits, right? And inflow of economic benefits, right? Okay. Now, once we invest all these kind of finance, buying assets, what is the purpose to invest? The purpose to invest to produce product and service. After you produce product and service, this is called cost, right? After you produce and service product and service, you're gonna sell. This is called sales, right? Sales or income. money that you're going to earn it. And you know that income minus expense or sales minus cost will be profit. And what is another name of profit? Profit means economic benefit. Economic benefits. So if you do not have assets, can you produce product? No, because you need resources, and resources are assets. If you do not have assets, can you produce? No. If you can't produce, can you sell? No. If you can't sell, can you have economic benefit? Can you have profit? No. So idea is, because of assets, can we say assets lead to inflow of economic benefits? Can we say that? Assets help us to increase the inflow of economic benefits. Because of assets, we generate profit. All right, that's the meaning of this. Now, you borrow money from bank. This is bank loan. You borrow money from bank. If you borrow money from bank, you have to pay interest. You have to pay interest to bank because you borrow from bank. Where this money come from? This money come from economic benefits. So you have to pay. If you pay, your economic benefit will be out because you're paying the money out, right? That's the meaning of outflow of economic benefit. Is that clear?
Yes, thank you, teacher.
Any other question before we move on to the element? Or we start with elements? Okay, so let's start. So the first element that we discussed in the last lecture was assets. And you know the meaning of assets. So of course, we are not discussing about the meaning of asset, right? Okay, now we will discuss about the types of assets, right? So in order to understand what inside assets, we have to look at the types of assets. So there are two types of assets we have. All right, so we have two types of assets we have. In these two types, the first is a non-current assets, or sometimes we call it fixed assets. Non-current assets, or we call it fixed assets. Right. So non-current asset or fixed assets. And second type of asset is a current asset. So we're discussing about the first element. So non-current assets or fixed asset and current assets. Now, what is the meaning of current and non-current assets? So non-current assets is the assets that we cannot convert into cash without losing significant value, right? Which we cannot quickly convert into cash. That's called the non-current asset, right? So the best example that we're going to discuss next, non-current assets include land, building, plant, machine. When you need money, when you need cash, can you quickly convert your land, building, plant, machinery in cash? Of course not. You need some time for marketing. You need some time to find the buyer. Once you get the buyer, then you have to negotiate with the buyer in order to get the more profit. So you cannot quickly convert into cash. If you want to convert into cash, you have to give very huge discounts to the buyer so buyer can purchase. Otherwise, nobody gonna buy, right? So means you don't want to lose money by giving discounts. So that's why converting non-current assets in a cash is a time-consuming process. You cannot quickly convert into cash. That's the meaning of non-current asset, right? Next is current assets. And current assets, obviously, you can see the name. Current asset is the assets that you can quickly convert into cash. You can quickly convert into cash. That is your current asset. All right. Now let's start with the types of non-current asset. What inside non-current asset? So these are the non-current asset. So in non-current asset, the first, so generally non-current asset divided into another two parts, which are tangible, and which are intangible. Tangible non-current assets and intangible non-current asset. Do you know what is the meaning of tangible and intangible? What tangible means?
You can touch, something like that.
Sorry?
Tangible means something that you can touch it.
Yes, that's right. Tangible assets are those assets that you can touch, you can see. You can see that, you can touch it, that's called tangible. And intangible asset is that kind of assets you cannot see, you cannot touch. All right? So tangible assets involve, first is a land and building. Land and building. Land and building, you can see, you can touch. So obviously, that's your tangible assets. Second thing is the plant and machinery. Plant and machinery. You know machinery. Machinery is a machine. You need a machine to produce product. Now plant. This plant doesn't mean the tree. This plant means the area which is suitable to run the business. That's your boundary, your business boundaries, right? Your areas in which you establish or you set up your plant, you set up your machines and everything. That's area called the plant, right? Plant where you are manufacturing your things, right? That's called the plant, right? So plant and machines, also tangible. And next is tools and equipments. Tools and equipments, also your tangible assets. Then maybe you require some furniture and vehicle. So furniture and vehicles are also your tangibles, you need car, truck, maybe motorbikes, and so on to run your business. Besides this, we also have some other kinds of tangible assets which may not be very common nowadays, or which may not be common for some kinds of businesses. That's called the livestock. Anybody knows livestock? What is the meaning of livestock? Do you know? Livestock means when we are using animals in our business. That's called the livestock, or we also call it biological assets. Not only animals, but of course some plants and trees. These calls the livestock. So let me give you example. Like as if you take example of Vietnam, in Vietnam, in some villages, some farmers, they use tractor to cultivate the rice, to grow rice, right? This is called vehicles. And some farmers, they may not, or they cannot afford the tractors. So that's why they use buffaloes, or they use some bulls and stuff, right? Animals. So they use animals to grow some rice, right? So that's called the livestock. So that animal is the livestock for that farmer. That livestock is assets. So the farmer using assets to produce product, which is rice, to sell rice, to make profit, make money, right? And same thing happened with like another example is some people, they raise some chicken, right? And they raise some chickens, some pigs, or some other kinds of animals. So let's say if you take example of chicken or ducks, people raise chicken and ducks, and they sell the eggs, or maybe chicken meat, depends, but generally they raise chickens for the eggs. We call them poultry farms. So these chickens are example of your livestock. Similar to the animals, some people, they raise some, they have some gardens, so they plant some trees, and of course occasionally you get seasonally, sorry, you receive the you get the fruits or the vegetables, and then you sell it to make money. So these are the tangible assets, right? You have maybe some other tangible assets too, but I'm talking about the most common tangible assets that most of businesses you can find it, right? Reason to write livestock is that because sometimes some people, they do not understand whether these animals, they are using those animals to conduct the business, they should be treated as an asset or what, because they are investing money in that animals, right? So how they should be treated that kind of animal, whether it's assets or not. And of course it's animal is an asset for the company because it's your investment, investing your money, right? Now move on to the intangible asset. Now what inside intangible? So intangible asset is any kinds of asset that you cannot see, you cannot touch. So intangible assets involve trademark, or logo. All right. Do you know trademark or logo? Yes or no? Do you know what is the meaning of trademark or logo?
It's kind of like
I don't know
brand
trademark.
of the. It's
Yes.
kind of like a brand of the company.
Yes, it's a brand. You can also call it brand name. Brand name. Brand name. Like Apple company, Apple, one bite with the Apple is the logo for the company or trademark for the company, right? Second thing is intangible assets could be copyright. Do you know copyright? What is the meaning of copyright? Yes or no? So like, for example, sometime if you write KFC, KFC. Under KFC, sometimes they use C like this, or sometimes they use write TM. TM, I don't know, you notice or not, TM stands for trademark and C stands for copyright. Now, copyright means any other business, they cannot copy the name of this company. Copy or, yes, generally they cannot copy the name of this company. That's the meaning of copyright. All the big businesses, even nowadays small businesses too, they have a copyright. So it means any other business without their permissions, they cannot open another business by the name of KFC. For example, if I want to open a new restaurant, I cannot start restaurant by the name of KFC, because they have registered their name. They bought the rights to use their name. So it means the KFC company, only KFC company has a right to use KFC name on their products. Same thing happened with the Apple. If I want to open a new company by the name of Apple, that's not true. I mean, that's not going to be happen. The other day, I think the last year, at the end of last year, I was reading one business news. I don't know, you know that news or not. One electronic shop in Hanoi, of course, in Vietnam, in Hanoi, they open electronic stores by the name of App Store. They write the name App Store, or they write the name Apple. But of course, they did not use the Apple logo, but they used the name Apple Store or App Store. They use some kinds of that kind of name. And of course, and later on, Apple came to know that, and Apple report that, and they asked them to put that name down or change the name. And then from the Apple Store to change, they changed something else. All right. So that's the meaning of the copyright. You don't have a right to use their name. Only that company, if you want to use the name of, if you want to open a name, same name, you have to take permissions from the company, whatever name, company name you are using, right? So that's the meaning of copyright, right? Copyright and patent. Do you know patent? Anybody knows patent? Patent, it's like as inventions. When you invent something, you buy the patent. I mean, you registered your patent. So it means this is your inventions. Another example is a formula, right? For example, nowadays, many medicines companies, most of them have I don't know, what are you writing in Vietnamese? I don't understand, but you write in English. That's better. Like as nowadays, many medical companies, they are producing a vaccine. And once they produce the vaccine, and making vaccine is a making formula. So if I am producing vaccine, this is my formula. So I will patent my vaccine formula. If you want to use the same formula, you have to buy that formula from me. I will. So you have to buy formula means you don't need to pay me good money. So what condition I'm going to make it? So in future, if using my formula, if you produce vaccine and you sell vaccine, whatever profit you have, I have some share in your profit. That's normally happen under the patent. You invent something, some kinds of inventions. So obviously that's mainly for the inventions, innovations, or any kinds of invention, any kind of technology you are using, you have to pay patent for it. Let me give you the best example. It seems like the license conferring a right and a title for a set period, especially the sole right to exclude the others from making, using, or selling an invention. It seems like you copy this one from internet. Please don't do that. All right, just try to explain the things in your own words. If you explain the things in your own words, you better understand. If you do not know the meaning, that's fine, but please don't copy and paste if you don't know. It's not important to give me answer. Important is you give me answer by yourself without copy paste. It seems exactly like as you copy. Anyway, so listen me carefully if you do not know patent. The another example, the best example for patent is like as smartphones. Smartphone, we have an operating system, right? Like for example, if you are using a Samsung smartphone, we have Android. Android is the operating system, right? So of course, and Android is a product of Google. Yes, I think it's a product of Google. So if you open a smartphone, you need operating system. So Google already developed operating system. So, but Google has a right of that operating system. Without Google permission, you can't use it because Google only bought the patent of that Android. So if you want to use the Android, because without operating system, mobile phone is completely useless without operating system. Whatever software things we are using in a mobile phone, that everything happened because of operating system. Same thing with the Apple company. Apple company, they have a iOS, is the operating system of Apple product, but of course, only Apple company has a right to use that patent. Apple company. Okay, so everybody understand the meaning of non-current assets, the what inside non-current asset. Is that okay? Non-current assets, everybody understand the patent, copyrights, logo, trademark. So now we move. Yep. So now we move on to the current asset. So what inside current asset? So current assets, the first current asset is cash. So current asset means any kinds of assets that we can quickly convert into cash. So obviously cash is the current assets. Second current asset is accounts receivable. Accounts receivable. Now, what is the meaning of accounts receivable? What is account receivable? Okay. For example, account receivable, for example, when you sell product, you sell, right? Sales. When companies sell product, company has two options to sell product. One is sell by cash or sell by credit. Cash means you sell now and customer pay you money right now. Customer pay you money now. That's called cash sales. And in credit sale, customer pay you cash later. When customer pay you cash later, that's called credit sales. So when customer pay you cash later, that customer become accounts receivable. Customer become account receivable. The person who pay you money later, that person become accounts receivable. So what does it mean, account receivable? Receivable means receive. Account means person, because in accounting, you prepare accounts related to each person. So receivable means you receive, and accounts means person. So account receivable means a person from whom we have to receive money. Why we have to receive money? Because we sell product on credit. That's called accounts receivable. That's the meaning of accounts receivable. Understand? Yes or no? Is that okay? Account receivable. Everybody's okay with account receivable? Can you hear me? Can you say something? Is that okay? So make sure you remember all these kinds of assets, something that I will explain you, because if you do not know, then when we start topic 2, you're gonna have a big trouble, right? If you do not understand these. So account receivable is a current asset because in a short period of time, later means of course 1 month, 2 months, 3 months, or maximum 1 year. They have to return money to you. Now next, current asset is closing inventory. Closing inventory. Now, what does it mean, closing inventory? Closing inventory is any inventory, any product or material, any product or material left at the end of the day. End of the day. That's called closing inventory. In very simple language, closing inventory means any kinds of unsold product. Unsold product. Unsold product called closing inventory. You haven't sold it. You haven't sold it. So obviously something left, something you don't sell at the end of the day. For example, today morning, you wake up to cook your breakfast. So you go to the kitchen and you came to know that in your kitchen, you have 2 bowls of rice. Can you please write down in English? Don't write in Vietnamese. I do not understand. Closing inventory, blah, blah, blah. So I'm giving example of closing inventory if you do not know. So listen to me. So let's say you wake up in the morning, today morning. You see you have 2 bowls of rice in a kitchen. But of course, that 2 bowls of rice are not enough for today. That's not enough for today. So you cook, let's say, 4 bowls of rice more. Right? So now you got total 6 bowls of rice. So we're going up. So you got 6 bowls of rice. And all day. So you total, you have 6 bowls of rice. And all day you ate 5 bowls of rice. How many rice left at night? When you're going to sleep, you see how much left? 1 bowl of rice. So this 1 bowl of rice is left at the end of the day. So that 1 bowl of rice become your closing inventory. That's the meaning of closing inventory. Something left at the end of the day, end of the period, end of the month, end of the year, depends what is your period. So I give you very daily examples. On the basis of daily example, 1 bowl of rice is your closing inventory. And why it's assets? Because something left. The product you already sold to customer, that product is not your asset anymore because you don't have a right to keep that asset. You don't have a right to use that asset. Customer bought it. So it means now customer has a right. But something you haven't sold it. something still is in your hand, that's your assets. All right, that's why closing inventory, which means unsold product at the end of the period, or unsold product, obviously unsold means something remain in the company at the end of the day, at the end of the period, that's called closing inventory, something left at the end. Is that okay? Understand? All right. Now let's move on to the next next current asset. The next current asset is a prepaid expense. Prepaid expense. Right. Prepaid expense. Now, what is the meaning of prepaid expense? As you can see the name prepaid. Prepaid means any kinds of expense that you paid in advance. Any kinds of expense that you paid in advance, that's become your prepaid expense. That's become your assets, current asset. Now, what does it mean paid in advance? Why paid in advance means current asset? So always remember one thing. Assets means rights, privilege, right? Asset means right. You have a rights on that asset. Something that you paid in advance, you have a right to use that assets if you pay in advance. So for example, let's say you have a mobile phone, right? You have a mobile phone and you use a prepaid mobile phone. Prepaid means you recharge first, you top up your mobile phone first, right? And then you use. So when you recharge, means you are paying money in advance. So once you paid money in advance, then you bought a right. You bought a right to use. That's the meaning of prepaid. That's become your asset. Why? Because you have a right to use it. Exactly same thing happened with your studies. In universities, you have to pay tuition fee in advance, right? You pay tuition fees in advance for every semester or every year. So when you pay tuition fee in advance, so means you have a right to go to school, come in the class to attend the course for you have enrolled, right? That's the meaning of right. Same thing happened when you're renting a room. So you rent a room, you have to pay rent in advance. You pay rent in advance, so you have a right to use that room. If you're paying rent in advance, that's called prepaid rent expense or prepaid expense, and that's become your current asset. So anything in a business that you paid in advance, any expense, any money you pay first without taking any service or without taking any product, you paid money in advance, that's become your current asset. Remember, you are paying. You means company is paying, because we prepare accounts or prepare financial report for company. So everything is company point of view. When I say you, so obviously I mean you as a company, right? So when you pay money in advance, that turns into prepaid expense, right? So that's all. So we have 4 types of current assets. We have 4 types of current assets. So current assets, finished. Non-current assets, finished. Types of total assets, finished. It's number 1. Total assets, finished. Any question or we move on? All right, so let's move on to next. Again, we are discussing about the elements, financial information. So now we are discussing the second element. And the second element is a total liability. Total liability or liability, whatever you better say, called total liability. So this is the second element, right? Now, you know the meaning of liability, outflow of economic benefits or obligations or something that you owed, right? So you borrowed, you have to pay. Same like as assets, this total liability also divided into two parts, right? So 1, 2. So total liability involves current liability, and non-current liability. Non-current, or you can call it fixed liability. Now, what is the meaning of current liability? Current liabilities are those liability that you have to pay because this is your liability, this is your obligation, you have to pay. Your outflow gonna happen from your company. So current liability is a liability which is fall due within a year. Means you need to pay off within a year, right? So another name of current liability, we also call it short-term liability. We also call it short-term liability, right? Short-term liability, any kinds of liability within a year. So you have a maximum 1 year to return that money back. Very simple language. That's called liability, current liability. And non-current liability, of course, it's a fixed liability. Fixed liability or long-term liability. So long-term liability. Long-term liability. Long-term liability means you have minimum 1 year. You have to pay after 1 year, maybe 2 years, 3 years, 4 years, 10 years, depends upon the contract that you have signed with the borrower, or I mean with the lender. Right? Now, what inside current liability? Current liability, the first things that part of current liability is a opposite of account receivable, which is accounts payable. Accounts payable. Now, what does it mean, accounts payable? Accounts payable is the opposite of accounts receivable. So what is accounts payable? Let's take example. When you purchase any supplies, purchase means when you buy any supplies from supplier, you have two options to purchase. One, you purchase by cash, means You buy now and you pay now, right? Like normally we do when we go to supermarket, right? And another option is you purchase on credit. Purchase on credit. Purchase on credit means you will pay later. So cash means you pay now. You pay now. And here you purchase, you pay now, you purchase now, but you pay later. So if you pay later to someone means let's say supplier, because you purchase material from supplier. If you pay later to this person become accounts payable. All right. So what is the meaning of accounts payable? Means you have to pay. Accounts means person. Accounts payable means the person to whom you have to pay later, or money you need to pay. When you have to pay? Within a year, because it's a current liability. Same thing. Account receivable, you receive. When you receive? Within a year, because it's a current assets, right? So receivable, receive. Inflow of economic benefits, current assets. Accounts payable, you have to pay. Outflow of economic benefits, current liability in a short period, so that's why current liability. All right. So understand accounts payable. Is that okay? Accounts payable. All right. So now let's move on to the second current liability. Second current liability is a bank overdraft. Bank overdraft. All right. Now, what is bank overdraft? Bank overdraft is exactly like as credit cards. Now, how credit cards work? Let me give example. So for example, company give you a bank give you a credit card, right? When bank give you credit card, so credit card means bank is giving you limit to withdraw money using this credit card. So means in simple language, credit card is basically the key to borrow money. So let's say your limit is a $5,000. So in simple language, you can withdraw up to $5,000 using this credit card from bank. So means you can borrow $5,000 from bank via these credit cards. So means you go to ATM or you go for shopping and then you swipe and you withdraw, right? So then of course, if you withdraw from this money from bank, it means you borrow from bank, you have to return money back. And of course, you return money back in a short period of time. If you will not return in a short period of time, that's fine. Bank will not charge any interest. But if you take longer period, the period that bank has decided, if you're taking more than that, then bank will charge high rate of interest from you that you don't like it. All right, that's the meaning of bank overdraft. So what does it mean? It's your obligation to return this $5,000 back to bank if you use it. That's become your bank overdraft. Right. So in another language, in accounting, another name of bank overdraft is a negative cash. Negative cash means when your cash balance is in negative, means you have to return this. This $5,000 is your cash, but it's negative. It's not your cash. It's a bank cash, so you have to return that money back. Right. So that's the meaning of bank overdraft. So bank overdraft is your current liability. Right. Next, liability is outstanding expense. outstanding expense. What does it mean, outstanding expense? Outstanding expense is any kinds of expense you haven't paid it. It's time to pay, time already gone, but you haven't paid that expense. That's called outstanding expense. Outstanding expense means expense which is due. What does it mean, due? Due means unpaid. You haven't paid it. For example, you prepare accounts. You prepare your financial account weekly, every week, Monday to Sunday, right? And you pay rent, your house rent or any rent also weekly. So your rent due date was Saturday, but you didn't pay. On Sunday, when you prepare your accounts, your rent expense will be treated as a current liability. It's your expense because you're supposed to pay on Saturday, but Saturday already gone. Your due date already gone, but still until now you haven't paid. You have obligations to pay because you have to return back. This is your obligation. Obligation means liability. Short-term liability because short-term obligation. You have to quickly pay your bills. If you're not going to pay your bills, probably your fine, your penalties will be keep increasing and your liabilities keep increasing, right? So any kinds of expense, time to pay, but you haven't paid. Due date already gone. Due date already passed. That expense is not your expense. That will become your liability, which is your current liability. Your tuition fee. If you pay your tuition fee on time, that's not your current liability. That's simply your expense, study expense, or your school fee or school expense if you pay tuition fee on time. But if you do not pay your tuition fee on time, then this is not your regular expense. That regular expense become your current liability. It's become your liability to return to pay your bills, to pay your tuition fees to the school. All right, due date already passed. All right, which is unpaid, on due date. Time to pay, if you don't pay, is become your outstanding expense. Is that okay? Understand? Outstanding expense. Again, you have to remember all these things because next lecture, when we start next topic, then you really need all these things. Is that fine? Move on to next. Any question or move on? Say something, can you hear me? Any question, outstanding expense? Next is unearned revenue. Another name of unearned revenue is unaccrued income. Unaccrued income. Unaccrued income means unearned revenue, right? Now, what does it mean, unearned revenue? Unearned revenue or unearned income. You can call it unearned revenue or unearned income. Unearned income is any kinds of income that you haven't earned. haven't earned, or an earned income is any kinds of income that you receive in advance. The income that you have received in advance, that's called unearned income. Now, what is that? So income means sales. There are two types of income. One is a earned income, and second one is unearned income. Obviously, we are talking about unearned income. What does it mean, earned income? Okay, now what does it mean, earned? Earned means when you already performed. You already performed your product or service. You already performed your product or service. You already delivered your product. You already delivered your service. That's called earned. Unearned means you have not, you haven't delivered, your product or service. You receive money, but you haven't given product. If you receive money, that's become receive in advance. Is it possible? Yes, it's possible. Receive in advance. The best example is a birthday cake. When we go to the bakery shops to order for birthday cake, and it takes 2 or 3 days to get your birthday cake ready. But the shops, they ask you to pay money. So when shop receive money from you, did shop give you cake right now? No, shop didn't give you cake. Shop received money. So the money that shop received, that become income, but this income is an unearned income. You haven't earned it. You just receive money. You haven't earned. You haven't delivered your product. You haven't provided any services to the customer, but you already got money, right? You perform service later. So you haven't performed service. You haven't delivered any product. So now this is your obligation to give product or service to the customer. Is your obligation. That's why this is your liability. And why current liability? Of course, you have to deliver this product or service in short period of time. That's the meaning of unearned income. That is your unearned income. Is that okay? Is that fine? Unearned income. Did you understand unearned income? Okay. One thing I want to remind you again, whatever I am explaining you, that will be part of your exam. So make sure you understand it. What does it mean? All right. So that's all about your current liability. Now, current liabilities are finished. Now let's move on to the non-current liability. Now, what is the meaning of non-current liability? Non-current liability, of course, as I explained you, that you have to pay off after 1 year, depends upon the time. So the best example for non-current liability is a bank loan. And always remember, bank loan means borrow from bank. Borrow from bank. When you borrow money from bank, do you need to give any assets to bank? Yes, as a security. This is called a mortgage. Mortgage means when you give assets to bank as a security. Security for what? Security about loan. Security about the money that you are borrowing. In case if you do not return this money back, then bank will take your assets, sell it and recover money. This is called a bank loan. And bank loan is your non-current liability. So did you understand? Yes or no? The meaning of mortgage means when you give assets to the bank as a security. You borrow money from bank needs some security from your side, your land or your building. So you give your land document or your building documents to the bank, and then bank will lend money on the basis of your land and building documents. Okay, so I explain you bank loan again if it's not really clear for you. Right? For example, that's you, right? You need money. So you will go to bank to borrow money, right? But before bank lend you money, bank require some security from your side. Some security from your side. Now, what is a security? It's a security for the money that bank will lend to you. For example, you borrow $10,000. So bank need any security. Security means any assets, your assets. Bank need any assets from your side, which value is more than $10,000. The assets value more than $10,000. Why bank need that security? In case if you do not return this $10,000 back to bank, bank will take the assets from you to recover this $10,000 back, because the value of asset is more than $10,000. So bank can easily sell in a market. Bank doesn't care on that asset have a profit or have loss. As long as bank receive $10,000, that's fine. So that's why bank require assets more than $10,000 if you do not return. If you return money back to bank with interest on time, then fine, bank will return your assets back to you. So this is called mortgage. So mortgage. Now, what is the meaning of mortgage? Mortgage means when you give your assets to bank as a security in exchange of borrowing money, that's called mortgage. So that's the meaning of mortgage. Is that fine? Is that okay? Any other question? So now the next elements of financial information is equity. So we can have a break now, and after break, we will start with the equity, right? So we can have a break. Now let's start with the equity. So as I explained you before, equity, it's a residual interest. So it means whatever is left in a company, that belongs to the shareholders, all right? So equity. Now, so what inside equity? So first of all, in equity, we have a share capital. What is the meaning of share capital? Share capital is the amount of money that company raised by selling stocks among shareholders. Right? It's the money that company raised by selling stocks among shareholders. Whatever money company get it by selling stocks, that money called share capital. And share capital is your equity. All right. Second thing is a net profit. Net profit minus drawing. So what is net profit? Net profit, we will study next element, which is income and expense. So income minus expense. That's called net profit or net loss. It depends. Now, what is drawing? Now, drawing means any assets which is withdrawn by the owner for personal use. That's called drawing. For example, my company produced this pen. So I'm the owner of company. If I take this pen from the company for my personal purpose, that's called drawing. And drawing reduce your net profit. Now, the question is why we have to subtract drawing from net profit. In order to understand these things, we have to go back to the previous information that I provided you before. So same thing. We start a company, we need finance. Finance comes from equity, which is selling stocks, and finance comes from debts. So we are talking about equity here. So finance comes from equity. Equity means we sell share, right? We are selling stocks to raise finance. And what we're going to do with this equity, we will invest to buy assets. And once we have assets, we will produce. If we produce product, we sell product, we have a profit. Right? Profit means net profit. Now, if the owner of business, the business owner, if business owner takes some, let's say, product, maybe cash, which is here, or cash or product. If the owner of company withdraw product from company, so technically company company profit will reduce, because if you have less product, you have less sales, less profit, right? So the idea is that shareholders invested money in company, so the purpose to maximize profit. But if the owner of company withdraw anything for his or her personal purpose, company profit will be negatively affected. Company profit will be reduced. That is the logic here to reduce drawing from net profit. So when you have a question, you have to check carefully in the question whether do you have drawing or you do not have drawing. That is the purpose behind this drawing. So net profit minus drawing always, if you have a drawing in your question. So they write very clear about the drawing in the question. So that's all about equity. So equity is finished. Any question about equity? Any question? Yes or no? Say something. Student, do you hear me? Any questions?
Yes. Can you explain again the start of the equity to the net profit?
Okay.
Uh,
It's the
how-
same. Yeah.
Is that the questionnaire in the produce, and what's that?
It's the
What
same
that
thing that
is?
we covered before.
Oh,
We start business. What we need finance. Finance comes from
yes,
selling stocks, right? Selling
Yes.
share. That's called equity. Once we have
Yes.
equity, we invest this money to buy assets, right?
Okay.
And once we have assets, we produce. After produce, we sell. After sell, we have profit. So
Yes,
that's
okay.
the process. After production, we sell profit, sell and profit. Sales minus cost. Produce is the cost. You go back to the notes that I mentioned just before the break time. Exactly same thing. So the idea
Yes,
is
yes.
that if the owner of company withdraw cash, means your resources will be reduced. Resources reduced, production reduced, net profit reduced. That's my minus. If the owner of company withdraw product from the company, if product from the company, you will, if production reduce, you will sell less product. You sell less product, less sales, less profit. So that's why we have to minus, subtract this drawing from your profit every time when we calculate equity. That's all for equity. So now can we move on to next? Number 4?
Yes.
Okay, so let's move on to number 4, which is income and expense. So I'm going to combine this income and expense so you can understand. So number 4 is income and expense. Income and expense. So this is 3 and 4. Sorry, which is 4 and 5. 4 and 5. Okay, this income and expense called income statement, right? This income and expense called income statement. So income statement is a statement that provide information about income and expense. So I'm going to show you how income statement looks like, but I will not go in very detail because of course we have a one chapter about income statement, but I'm going to focus here more on the what is income and what inside expense. Right? So income minus expense is profit or loss. So basic ideas from income. So income. So there are, what does it mean income? Income is making money, right? Generate money. So there are two types of income. Income categorized into two parts. One is a operating income. Operating income. And the second one is a non-operating income. Non-operating income. Right. Now, what does it mean operating income? Operating income is the income which comes from selling product and service. When you sell product and service, whatever money you make it, whatever money you generated, that's called operating income. Right? Income from selling product and service. Non-operating income. Non-operating income is the income which is of course not from selling product and service. Which income come from the other source of income that company has. What are the other source of income? For example, company receive rent received because, for example, company has a three floors building. In the 3-floor buildings, company using 2 floors and 1 floor is left. I mean, company not using that floor. So company gonna put that floor for renting. So whatever money company generated through that renting, that's called rent received. Second one is a interest received. You have some money, you keep that money in bank, and banks give you interest time to time. You earn money, that's also your income, right? Interest received. Maybe company sold assets. Let's say company have some assets, that company asset is not in use anymore. Some company sell it, company generate money. That's called non-operating income. Maybe another could be, let's say, company receives some discounts. Received discount. You sell product, or you purchase, not sell, you purchase raw material, and supplier is giving you some kinds of discounts. That's also your non-operating. So you can see that all these other non-operating income, nothing belongs to the product and service. So all these are called non-operating income. So always remember, operating means related to product and service. Non-operating, which is not related to product and service. That's your income. Now, let's talk about expense. Talk about expense. Same like as income, expense also divided into two parts. Expense, spending money. So we have operating expense, and non-operating operating expense. Operating expense and non-operating expense. And operating expense, of course, that expense belongs to the product and service. Now, this non-operating expense divided into two parts. We have two types of operating expense. One is a manufacturing expense, one is a non-manufacturing expense. We have manufacturing expense and we have non-manufacturing expense. Manufacturing expense and non-manufacturing expense. Manufacturing expense that we will not discuss here because you have another subject which is management accounting, but I'm giving you quick ideas about manufacturing expense. Manufacturing expense means any kinds of expense involved to produce product. Let's say we are producing a pen. So we have, let's say, material is your manufacturing cost. Labor who involved to produce this pen, manufacturing cost. Maybe some other expenses involved to produce this pen. Non-manufacturing. Operating, but non-manufacturing. Non-manufacturing, for example, marketing, advertising, right? Packaging, labeling, distribution, transportation. So manufacturing mainly any kinds of expense that belongs to factory. Because in factory, we produce product, and non-manufacturing generally expense belongs to office. The people working in an office, marketing department or some other office, not factory, because every company have a two section. Manufacturing company has a two segments, factory and office. That's the human resource department, account department, marketing department, sales department, IT department. All this belongs to office. And factory, mainly production department, where we only produce product. Now, non-operating expense. Non-operating expense is any kinds of expense that has a not direct or indirect effect to the product, right? So, what inside this non-operating expense? This non-operating expense involve interest expense. You borrowed money from bank, right? And you have to pay interest. That's your non-operating expense. Next is a tax. You have profit and you have to pay tax. So tax expense. Tax expense is your non-operating expense. And the third one is a dividend expense. Dividend expense. Do you know what is the meaning of dividend? Do you have any idea what is dividend? Tell me what is dividend. Do you know dividend? Yes or no?
No, I
No?
don't know.
Okay. So I explain you what is dividend. So in order to understand dividend, again, we have to go back here to this point. What is dividend? Same thing. You want to start a company, right? Then you invite shareholders to invest money in company. When you invite shareholder, then you give them promise. Why shareholder why people invest money in company? Why shareholder invest money? Shareholder invest money to make money. To make money. So you give promise to shareholder to help them make money. So means you take money from shareholder, you use that money, you make profit. From profit, you give them a dividend. So what is the meaning of dividend? Dividend means profit sharing among shareholders called dividend. All right. Profit sharing among shareholders called dividend. That is the meaning of dividend. Right? So in simple language, you take money from shareholders, in exchange, you give them promise to pay them dividend. And how you pay them dividend? If you make profit. You make profit, you pay them dividend. You don't make profit, you don't pay them dividend. But of course, you put your efforts in a business so you can maximize the company profitability. So you can maximize shareholders' money too, which is dividend. That's the meaning of dividend. Dividend words come from the word divide. Divide means distribute. So when you distribute net profit among shareholders, that's called the division, right? Or that's called the distribution, right? So profit distribution or profit sharing among shareholders, that's called dividend. So you have to pay dividend, become your expense. But dividend could be your income. Let's say company A invest money in company B. So means company A is buying share of company B. So means company B has to pay dividend to company A. So it's a dividend income from company A. So if you invest money, you receive dividend, right? If you sell share to have money from shareholder, then you have to pay them dividend time to time. And of course, we always pay dividend from profit, right? So that's why dividend expense, it's your non-operating expense. Is that okay? Understand?
Yes, understand.
Okay. Any other question before we move on? No questions. So then we move on to next. So now you already understand what is the meaning of income, and you already understand what is the meaning of expense. So income minus expense is profit or loss, right? So obviously, if income is more than expense, you have profit. If income less than expense, you have loss, right? So that is your element 4 and 5. So income statement means income minus expense, called income statement. So it's providing information about company profit and loss. So 5 elements are finished. Any question or we move on?
Move on.
Okay, so now let's move on to the next. So before we move on, I want to recall the previous lecture. So in previous lecture, we're gonna study various things in relation of financial accounting, such as, various things in relation of conceptual framework. For example, qualitative characteristics. What are the characteristics of company? Relevant, reliable, consistency, and so on, right? And second thing is elements, right? Now we move on to the third thing, which is operating guidelines. All right, so if you remember this operating guideline stuff that we will study in the, did you remember operating guideline? That I said that we're gonna cover the various things, we're gonna cover the characteristics, we're gonna cover the elements, and then we will cover the operating guidelines. So operating guidelines are basically principles or rules and regulations to record the information in your accounts. So if you wanna record any kinds of information in your account, you have to keep that's operating guidelines in your mind. You have to keep that principles in your mind, right? So we will start with operating guidelines. Operating guidelines. Operating guidelines provide information to record financial information in accounts. So operating guidelines give us instructions to record information in accounts. How are you going to record information in your account? This kind of information, we can get it through the operating guidelines, right? So now we start with operating guidelines. So these operating guidelines are divided into three parts, all right? So we have three different types of operating guidelines. So first is principles. Operating guidelines provide information about principles. Right. Second thing is assumptions. And the third thing is constraint. We get three different information from this operating guideline, and these three different information help us to record information in our accounts. So first is principles. Principles. Second one, assumptions. And third is constraint. Constraint. Now, what is the meaning of principle? Principle basically tells us how information should be recorded. How information should be recorded. When you're going to record information, what you have to keep in your mind, how information exactly should be recorded. Assumptions. It's provide the foundation of accounting process. Provide foundation of accounting process. Accounting process is the process that helps us to record the information, which consists of 5 steps. So in topic 2, you will study this accounting process. Before you understand accounting process, you have to keep in your mind the foundation, the basic things, before you apply this accounting process. I repeat, accounting process, 5 steps. So before you move on to these each steps, you need some basic things, and that basic things come from the assumptions. And the third thing is a constraint. Constraint permits company to modify accounting standard. So it's permits, it's allow company to change accounting standard. But of course, some conditions apply. You cannot deliberately change whatever you like in your accounting standard. Accounting standard means principles, rules, regulation that come from the accounting standard, accounting framework, conceptual framework. So if you want, you can change something in that conceptual framework. So in simple language, you don't have to follow accounting standard strictly. It's quite flexible. You can avoid, you can ignore something. But again, make sure your financial statement quality do not affect. That's you have to keep in your mind. Right? All right. So now let's start with the first principle. So the first principle is revenue recognition. Revenue recognitions. Revenue recognition means revenue income will be recognized as a revenue at the time of sales. Right? At the time you sell, not at the time you receive. Revenue will be recognized at the time of sale, not at the time of receipt. Let me give example. For example, today is Monday, right? You sold product to customer. You sold product to customer on credit. You sold product on customer credit. So means this customer will pay you money on Friday. Friday. So this is Monday. So this is today. So now the question is, today we sell product on credit. So means we did not receive any cash, and we receive cash on Friday. So now the question is, when I record this information in my accounts, can I consider as an income? Can I call it sales? Can I call it sales? Or I call it sales when I receive money? Of course, when I sell it. I sell it means I earn it. I earn it, I record as a sales. I don't have to wait to turn this earning into cash to record as a sales. But of course, the time I receive cash, it's become my assets, because cash is your asset. If you go back to your current asset, you will see that cash is your current asset. My cash affect, obviously, but today my cash not affect. So it doesn't mean that I will not call it income. Yes, I will call it income. I will call it revenue. I will call it sales. So always remember, revenue will be recognized at the time of sales. At the time of sale, we are selling today, I will be recognized as a sales. I'm selling tomorrow, I will recognize as a sales. I don't have to wait to receive cash to record this information as a sales. All right. So you don't have to wait. Don't need to say that, oh, I will receive cash tomorrow, so I will say that I receive income tomorrow. No, you sell today, so you record today, no matter when you receive it. All right. I'm talking about revenue. Don't say that if you don't receive your money, how can you run business? Of course, you're not going to run a business, but I'm talking about revenue. When revenue will be recognized, when you record information as a revenue, when you record item or money as a revenue, you will record as a revenue at the time you will sell, not at the time you receive. All right, that's called revenue recognitions. Right? Did you understand revenue recognitions? Revenue will be recognized at the time of sales, not at the time of receiving money. Is that okay?
Yes. So revenue recognition is when you sell a product, we will get the money at the same time, right?
If you receive money at the same time, okay, that's okay. Let me explain again. For example, you sell product. You sell product, you have three situations to sell product. One, you sell by cash. Second, you sell by credit. Third thing is unearned. Unearned means you receive only cash, but no sell anything. Remember unearned income, current liability? So
yes,
revenue recognition, the important is earning. When do you earn? Earn means when do you supply product or service? Whenever you deliver product and service, it will be considered as your revenue. Like here, did you deliver product and service? Yes, but customer is giving you cash, so you record right now. Did you deliver product and service? Yes, but customer pay you cash, no problem, because you already delivered. Okay. Third case, did you deliver product and service? No, but customer already paid you cash, doesn't matter, but this is unearned, so you will not record as income. This is not your sales, this is your current liability. Sales means income, current liability is liability. So this third option, so first, second, third, this third option, according to revenue recognitions, this third option is not your sales. This is your sales because you deliver product and service. Second, also deliver product and service. So time of sale. Time of sale. Did I sell? Yes. Did I sell? Yes. Did I sell? No. So I will not record as a revenue. So understand?
yes. Thank you.
Any question or move on?
I think we could move on.
Okay, so let's move on to the next, which is second one. So second principle is full disclosure. Full disclosure. Now, what does it mean, full disclosure? Full disclosure means whatever happened in company, you must record in your accounts. You should provide the full disclosure. Disclosure means disclose, inform. You should provide full information to the users through financial statement. So whatever economic events occur, economic events means any kinds of things which has a money value, which affect the money in or out, anything, inflow or outflow. So whatever economic events occur in company must be disclosed or recorded in accounts. You cannot ignore anything. You cannot avoid anything. Because if you're not going to record any information in your accounts, why we produce accounts? We produce accounts for the users. So if you're not going to record any information in your accounts, users will be lack of that information, and which affects users' decision. So maybe because of that lack of information, users can lose their money. So that's why it's very important to disclose all the important information which relate to the money. That all important information must be recorded in accounts so users can get the complete information about financial statement and make decisions accordingly. That's the meaning of full disclosure, full disclose, full information, all kinds of economic event related information. That's the meaning of full disclosure principle. Is that okay, full disclosure?
Yes.
Okay. If yes, then we stop here. But of course, principles, we haven't finished principles yet. We have one more principles, which is a matching principle that we will continue in the next class. All right. So if no question, then we stop here. So I'll see you next week, Friday.
Teacher.
Yep.
Can I ask, because the last week we talk about the starting time of our class at 8. So in the next week, we will start at 8 or 8:30.
8:30. Yeah, like us today.
Okay.
We will start 8:30 and we will finish 11:30, not 8 o'clock to 11 o'clock. Is that okay, 8:30?
Okay, okay.
Yeah,
Thank
okay.
you.
So we will start 8:30 next week, Friday morning.
Okay, thank you.
I'll see you next week. Thank you. Bye-bye.
See you next week, teacher.
Yeah, bye-bye.